Hello. Today, Michael Hislop and myself, Vanessa Pitch, will be presenting a summary of the article titled TradeWeb Announces First Fully Electronic SOFR Swaption Trade. This article was recently published on the Bloomberg website on June 2, 2022. Our presentation has three main components. First, we will describe what SOFR means. SOFR stands for Secured Overnight Financing Rate. It is a benchmark interest rate for dollar-denominated derivatives and loans that is replacing the London Interbank Offered Rate, commonly referred to as the LIBOR. Next, we will describe what a swaption is, some of its key components, and how it is traded. Lastly, we will discuss why the introduction of this new type of derivative is important to the financial markets.
Thank you, Vanessa. So a couple things about SOFR before getting into the article. SOFR is an interest rate that banks use to price US dollar-denominated derivatives and loans. The rate is based on transactions in the Treasury repurchase market, or the repo market, where investors offer banks overnight loans backed by their bond assets. Benchmark rates such as the SOFR are essential in the trading of derivatives, particularly interest rate swaps, which corporations and other parties use to manage interest rate risk and to speculate on changes in borrowing costs. Generally, SOFR is considered to be a more reliable benchmark than its outgoing predecessor LIBOR, especially in light of a 2012 scandal where it was revealed that more than a dozen financial institutions fudged data in order to reap bigger profits from LIBOR-based derivative products. A swaption, also known as a swap option, refers to an option to enter into an interest rate swap or some other type of swap in exchange for an options premium. The buyer gains the right but not the obligation to enter into a specified swap agreement with the issuer on a specified future date. Swaptions are generally used to hedge options positions on bonds, to aid in restructuring current positions, to alter a portfolio, or to adjust a party's aggregate payoff profile. Due to the nature of swaptions, market participants are typically large financial institutions, banks, or hedge funds. Large corporations also participate in the swaption market to help manage interest rate risk. Now for the article. So TradeWeb facilitated the first ever fully electronic SOFR swaption between New York's Goldman Sachs and Canada's CDPQ as counterparties. Since the completion of the trade, 15 dealers are now providing swaptions pricing on the platform. TradeWeb has been offering SOFR swaptions trading on its platform since the LIBOR transition at the end of 2021, and the latest development gives market participants a more efficient way to access market rates liquidity, using its request for quote tool to put multiple liquidity providers in competition. Cole Murtaugh, head of U.S. institutional rates at TradeWeb, said, quote, "Facilitating SOFR swaptions trading is yet another meaningful step toward the electronification of markets, demonstrating how non-linear swaps can also benefit from electronic execution and access to deeper pools of liquidity." The U.S. market for swaptions doubled in the last quarter of 2021 alone, and the growth has continued this year. TradeWeb reported a 42% year-on-year jump in average daily volumes for May, up to $215 billion. Given that in the first quarter of the year, TradeWeb accounted for 52% of all platform swaps and 71% of dealer-to-client swaps, that suggests a sizable market-wide jump. The electronification of trading is an ongoing trend in the swaps market, with a 2021 study from Coalition Greenwich finding that European swaps traders on the buy side already executed 45% of their trades electronically and expect growth to continue in the coming year.
Thank you very much for taking time to listen to our presentation today. Listed on this slide is a link to the article, which you can find on the Bloomberg website, as well as a few additional references. Thank you again, and we look forward to your feedback.